Alrighty. All right. Hello, everyone. Good afternoon, and thank you so much for being here. We really appreciate you taking time out of your day to be here. So, my name is Reagan, and I'm the operations manager here at NFI Solutions. And here at NFI, we help support independent annuity and life insurance agents all across the country, giving them access to great products, fast contracting, and day-to-day case support. So, before we get started, I just wanted to quickly go over a couple things. First of all, today's session is being recorded, so if you're not able to stay for the full webinar or you want to revisit anything later, we'll be emailing out a recording to everyone who registered. Secondly, we will have time for a live Q&A at the end of the session. So if you want to submit questions at any point using either the Q&A or the chat feature, you can do them publicly or privately, and we'll do our best to get to as many questions as we can. This session is built specifically for independent annuity and life insurance agents. So the goal today is a practical one. Many of you are having nuanced conversations with clients right now. Questions are coming up that aren't just about rates or performance anymore. They're increasingly becoming more about protection, stability, and how different pieces of a plan are working together when uncertainty shows up in the market. So annuities have long played an important role in those conversations, as I'm sure everyone knows. They're designed to provide that structure, income, and predictability. But as markets, policies, and economic conditions are continuing to shift, many clients are also asking about assets that behave differently from traditional financial instruments. So that's where we have gold and silver entering the discussion. Not necessarily as a replacement for annuities or life insurance, but as a complement. More as a way to think about diversification, purchasing power, and balance when confidence in the broader system feels less certain. So for the challenge for agents today isn't whether gold should exist somewhere in the financial universe, it's how to talk about it responsibly and how to position it alongside annuities and insurance products. That's what today's conversation is going to be about. So today's session isn't focused on predicting markets or telling clients what's going to happen next. Instead, it's about understanding how experienced professionals are thinking about gold and silver as part of a client protection strategy and how those conversations can fit naturally within a well-rounded plan that also already includes annuities and life insurance. So to walk us through that perspective, we're joined today by two individuals who bring both industry depth and real-world advisor experience to our discussion. So first, I'd like to introduce Ryan Long. He is the president of National Gold Consultants. Ryan has spent over 20 years working with gold and silver, partnering closely with financial advisors and insurance agents throughout multiple market environments. Today, National Gold Consultants works with more than 1,500 agents and advisors nationwide. So Ryan focuses on helping those professionals integrate physical gold and silver into their client conversations in a way that's thoughtful, compliant, and complementary to existing planning strategies. And today he's going to share more why agents are proactively addressing this topic and how National Gold Consultants supports advisors in practice. So also joining us is Kerry Morris, and he is a long-standing advisor partner with National Gold Consultants. He's going to bring in that advisor perspective, working directly with clients and implementing these strategies in real financial plans. So our objective today is simple. It's to help you think more clearly about how annuities and gold can work together to address client concerns around protection, confidence, and long-term planning. So with that, I'm going to turn it over to Ryan and Kerry to begin today's presentation.
Awesome. Thank you, Reagan. Really appreciate the introduction. Special thanks to NFI for hosting this webinar. My name is Ryan. As Reagan mentioned, Kerry here is my counterpartner, a co-host. Kerry is an advisor just like you. He is a CFP. He has been in this industry for a few decades as well, a true financial fiduciary. I actually met Kerry, I don't know, time flies, Kerry, but it's got to be 15 plus years now an RIA that we were both working with at the time, and time flies by. So thank you, Kerry, and thank you everyone for hopping on. Reagan mentioned gold and silver and the topic of conversation and how this isn't a substitution for annuities and insurance products. I really, before we go into detail of what we're going to be talking about as well in precious metals, I really just want to hit that nail on the head. right? This is not a substitution. This is an add-on, in addition to what you're already doing. I can't tell you how timely this topic is right now. Your clients are searching for it. Our phones are ringing off the hook. Advisors we haven't talked to in 10 to 20 years are coming out of the woodworks because they're bringing this up to their clients again because it's extremely timely. So I want to, again, introduce Kerry to y'all. Kerry, appreciate jumping on with me today.
Absolutely. Hey, Reagan said you weren't going to predict prices. Is that right? You're not predicting prices today?
Kerry, we're a day late. I lost my crystal ball yesterday, so we'll work on that next time.
So, hey, welcome everybody. Listen, Ryan and I, we like to have a kind of an informal way of covering this for you. So come on this journey with us for the next few minutes. It's kind of fun. You're going to learn some foundational things. I mean, when I first encountered Ryan that many years ago, it was like, wow, I had no idea really how to position all that stuff, even with all the crazy education, being a CFP, an investment advisor, insurance for 2 decades and all that stuff. It's like, this is some foundational things. It's almost so simple you'll miss it if you don't pay attention. So, Ryan, you're going to start with the why, right? Like Simon Sinek said, start with the why.
Well, I mean, you saw the headline, you saw the title, the gold conversation, right? It was titled "Where Physical Metals Fit in Retirement Planning." Okay, well, that was your clickbait. Here we are. So my question to you, rhetorically speaking, is why are you here today, right? Something obviously tricked, it either tricked you into it or your brain was like, you know what, I got to listen to this stuff because it's timely. This slide, folks, we could spend the next hour on this and covering, you're probably here because of one of these 4 reasons. I'd be remiss if we did that, so I won't. Man, that owl with his eyes just blinking at me. This is something else, Kerry. But maybe you find yourself here as an advisor like Kerry. Maybe you're a CFP. Maybe you're part of a broker dealer. Maybe you're just like the many that we work with and are insurance licensed only. There's no extra licensing that is required to be talking about bringing up precious metals to your client, because in all reality, whether you have these pains in the marketplace, the deficit, inflation, et cetera, your clients do. So it's extremely important to have this type of a timely topic right now. I mean, we used to have a list of 10 different things on here, right, Kerry, that we just simplified it. The elephant in the room, prices of precious metals are soaring right now. So when I said I lost my crystal ball yesterday, it's the truth. When we see precious metals rise the way they are, the question that I get that question, where do we think it's going to go? And I say, well, is gold and silver rising that high, or is your dollar just buying that much less gold and silver? Right. So it's all in perspective, Kerry. What do you have to add to this?
Yeah, so you see the top 2, you guys, those are foundational, big macro cycle type things, right? Like, I mean, the deficit in our country, it's a huge, we are multi-decade type cycles on the deficit. We're going to talk about that later. Inflation, that's a long swing, And then we get a little more short-term cycle-ish with the stock market uncertainty that's going on. What's crazy is the returns that people have had. Of course, I have to throw in there, when the government prints $3 trillion in 3 months in 2020, and that sets us on this course, but there's still all this uncertainty, even though people's balances are really up over the last, if they stayed in the market, right? So it's almost like people are smart enough innately, Ryan, to kind of know like, hey, this can't last. Right. And then you've got the long cycle of metals, but we're in this little short, this peaking and this, it's almost like spot price. Well, anyways, I won't get there. Let's move on, and we'll get into that other stuff in a minute. But FOMO, trade of precious metals, that's a big deal. And so we wanted to address that with you guys today, jumping on the webinar, because number one, this is a perfect time to bring this up because people are hearing it, their values are up. But we want you to have an ear today to listen from a perspective of what is long-term that you can add to your practice. Because we've been saying, what you're going to see today, we've been saying these same foundational things for over 20 years for Ryan, and a long time for me. So we happen to be in this certain place with precious metals, fear of missing out. that's motivating for your clients, but you can temper that and help them have a better foundation on their decision making by understanding what you'll hear today, what you'll get in the training Ryan's going to offer you, because you want them to have that to go through when the prices come down some, and to weather the storm, right? That's how they win long term. I've got metals that I've owned for a long time, and seen them go down and seen them come back up, but I'm not trying to time the market. It's a long-term thing. So what's most important to you is, what can this mean for you, right? Because if you're like me, you guys, you're marketing for new clients, you're servicing existing clients. I mean, that's what we spend our time doing as financial advisors, right? And we put a lot of time and resources, a lot of money, a lot of time into that. Hopefully you're doing it as a fiduciary, in 2026, but there's still a lot of uncertainty. Look at the uncertainty we face all the time as advisors on the marketing side of things, right? A mailer, if you're a mailer or a workshop person or a Facebook ad, regardless of how you're getting in front of people, we all know like it'll work great for a couple months and then it doesn't, right? And then it falls down. And so there's a lot of uncertainty for us sometimes in our practice. And this topic here, this has a chance to add something to what you're already doing to kind of help even out the flow a little bit, to bring not only another revenue stream for you, but a long-term hold, something your clients need in their portfolio to go along with these other things that you do. And of course, you're going to get paid. I shouldn't say of course, because you don't get paid for Social Security. A lot of times you don't get, for Social Security advisement or timing, you don't get paid for like encouraging people to get their legal docs most of the time. But with this, you do. So Ryan, break it down. It's pretty plain on the slide there, but I like to hear you say it.
I mean, we like to get this out of the way right away because, profit's not a bad word. It has to be done within reason, right? But we also, this folks is, I'm just going on an assumption here. Majority of the folks on here are insurance license only, right? So are you going to tie up 100% of clients' assets in insurance? Well, of course not. You can't, right? So if you find yourselves as someone like that, and I would say 75% of our advisors that work with us do, this is just a great addition to what you're already doing. I mean, your clients already trust you. They're searching for it anyways. You'll find that out real quickly. But in this, Kerry, you mentioned the uncertainty, and maybe you find yourselves marketing for other things, whether that's on social media all the way to mailers. You want to talk about the best marketing. It's called word of mouth. And if they find out that you're a resource for physical precious metals, you want to talk about a differentiating factor of an advisor. I mean, look no further. So no extra, insurance license only. Yeah, I get the question all the time. Well, I don't have my securities license. You don't need it for physical precious metals. Insurance license works if you're an RIA or an IAR. All it changes is your outside business activity aspect of it, or you're adjusting your ADV. And if you work with a broker dealer, talk to me about that as well. We might already work with them, or we'll get you in the door so you can. Okay.
That's right. Absolutely. And so, the compensation is part of a structure, you guys. I want to tell you this from my perspective as a customer, really, of NGC for so many years. The compensation that you get from NGC is not meant to try to compete with annuity compensation or anything. It's meant to fit within the structure of delivering a really great value to the client and you getting paid as well. Okay. It's a fun conversation to have. So I just wanted to help you understand that Ryan is basically a wholesaler in the marketplace, and he's passing on as much of that wholesale benefit to the end client as possible. So I just wanted to give you a place to put that. So another topic we want to hit before we get into the meat and potatoes, as Ryan and I like to say. I'm from Tennessee. He's from Minnesota. So I don't know. He still likes to say meat and potatoes. But why physical metals and not ETFs, right? Physical versus paper. Ryan, walk us through this.
Yeah, I've probably given this terrible analogy 1,000 times, Kerry, but I'm going to give another 1,001. Here we go. There's a vast difference between physical metal and paper metal. And so the illustration I paint for you is this, and I know you mentioned I'm from Minnesota. I moved to the promised land of Florida 2 years ago, Kerry. So let's not discredit that. That's where I am That's where I am right now.
The free state of Florida.
The free state of Florida is where I'm at. If I was to head down the interstate, hit Port Canaveral, which I just did for a cruise, it was fantastic. Happens to be the Titanic. We know the history of the vessel of what's going to transpire. And the crew member shakes my hand and says, "Hey, Ryan, I've got two options for you. The first option is a life preserver you can put around your neck right now, knowing the history of the Titanic, or I can give you a certificate saying you can redeem this for a life preserver. Which one would you take?" Right? And I say that to people and they go, "Well, yeah," an eye roll or maybe a laugh. The reality is physical metal and paper metal are extremely different. One is the real tangible. Proverbs, possession is 9/10 of the law. And the other one is essentially a paper promise that is not intended to deliver. What else do you have for that, Kerry?
Yeah, and so this slide says why physical metals and not ETFs. Let me just clarify. We're not saying ETFs are bad or don't own paper shares in your portfolios and et cetera, et cetera, et cetera. Nothing against paper shares. We're saying why physical metals and not ETFs for wealth preservation, for wealth insurance, for protecting what we're going to talk about today and getting this counterbalance. And so it's just hugely different, you guys. You can't trade that paper in for physical shares unless you, the last prospectus I read from a GLD or SLV was like you had to have $1 million. And there's what's called considered redemption. It really just doesn't exist, especially for the normal mom and pop shop or normal couple. So if you have any questions about that, we're going to move on. But, that's why there are two different things. So what we're going to say today, you can't get through paper. Why National Gold Consultants? So I'll just brag on NGC for a second. Ryan's second generation in the business, you guys. And he actually grew up with his mom running a jewelry store. He and his dad started this business a long time ago. They started on the retail side. You'll hear us talk against your clients doing business with retail. Let them do business with you instead. Right. And along the way, Ryan and his dad realized that, hey, all these people, that our marketing's bringing in, a lot of times they're stopping and asking, say, hey, well, let me talk to my advisor, right? Not that the advisor would really be educated about it, but so that's when they said, you know what, let's just do business with advisors and not do the retail side anymore. And so that's what they did. And so National Gold Consultants only works with financial advisors. Ryan has a few personal clients and that kind of thing, but they're not a retail shop, you guys. And so there's a huge difference in that. And so there's a process for everything. Ryan has a very systematized way of working with advisors. We'll talk more about that later. And you'll find that the National Gold Consultant story, it really is attractive to clients. It's important that clients understand, like, okay, you don't have to be an expert. You're connected to the expert, and you get to leverage all that history there. You agree, Ryan? What else about NGC you want to talk about?
The last thing I want to touch on, Kerry, is I'd be remiss if I didn't say this as well. Our company acts as a glorified IMO, but only in the gold and silver space. Okay, I know there's a reason why you're here with NFI because they're awesome. They're awesome to assist you to make your job easier and make you look better in front of your clients, right? I mean, it's just simple in what it does. That's what our job is here as well, for making you look good, making it simple in front of your clients in the precious metal space. Not all gold and silver is created equal. So we help you and equip you with branded materials, doodle videos, client webinars. I mean, all the things that a fantastic IMO would do for you, we do that in the gold and silver space for you. So I just wanted to add that, Kerry.
Amen. All right, so let's jump in, you guys, to the first foundational issue. We're not surprised by these price increases that we're seeing right now, you guys. We all know that it goes back to a foundational change from where the US of A used to have a debit card that the country would use for spending, meaning they had to have gold to back it up. We were on the gold standard. And in 1971, Ryan will talk about it, that switched over to a credit card. So we went from a debit card to a credit card as a country. and we disconnected those two things. So then the printing of money, the printing of resources, it wasn't connected to us having physical gold. And as soon as that disconnect happened, we knew certain things were going to be part of the repercussions of that over decades. And the dollar losing purchasing power is one of those casualties, Ryan.
It really is. Kerry, you stated this well. Prior to 71, the United States had to have the gold and silver in the reserves to back up the currency that's in circulation and on the government books, right? Well, when Nixon got up to the podium in 71 and he said, we're going to temporarily suspend the United States gold and silver standard, we're still here in 2026, temporarily suspended, right? And lo and behold, I mean, you can see this busy chart in front of you, this complete, dive down to what our currency, that's basically your purchasing power of your dollar. Ever since we got off that standard, it's just been almost like a sledding hill going straight down, right? What a lot of folks don't understand, and I find this, to my surprise, most agents don't understand, that in 1913, that was the creation of the Federal Reserve. Well, what's significant about the Federal Reserve and what folks don't know is they are actually a private entity. They're not a government entity. They're a private entity that controls the monetary supply of our entire dollar-based system. So when we got off that gold standard in 71, they're allowing now, without any consequences to their dollar or consequences to our dollar that we hold, no longer do they have to back the gold and the silver to do that. No, there's no reason, or there's a significance why when you look at inflation like we're seeing now, it's because there's no accountability. There's nothing in the vaults to back it, Kerry.
Yeah. So coming back to the simplicity, you guys, of a credit card, when you look at your credit card statement, you look at available balance, right? And you look at the current balance. So I can charge this much. Well, wouldn't it be nice if you could just write at the credit card company at any moment and just raise your max credit line, right? Raise your credit limit. Right. Well, that's kind of what we do here in this country, right? So yesterday it hit 39, Ryan, when we were talking, and today it's back down to 38.6. So walk us through this and hit that debt to GDP ratio as well.
Yeah. So if you haven't been on this website is fascinating. The usdebtclock.org. We took some of the noise out of this to hit home what we're going to be talking about here. But what's circled in front of you is our United States national debt. Back to get out of the 2008 recession, they printed $3 trillion over 5 years. To get out of the COVID era issues, they printed $3 trillion over 3 months. And that set the table and the standard of our monetary system. The government is adding $1 trillion towards our national debt every 90 days. So if you go 3 months from now, you're going to see, roughly $40 trillion of national debt. That this is, not sustaining. So it really begs the premise of why we're here. Are we surprised that gold and silver are rising and rising significantly? No, because it's going to where it needs to go to keep up with your purchasing power. Whereas the individuals and the folks that are losing significantly are the savers in this. So what's circled on the smaller circle on your screen is your debt to GDP ratio. And what that is, in layman's terms, if I was bringing in $100,000 of income for my family every year, but my expenditures was $124,000 every year. How long can you live in that system? Right? That is the same system our government is operating from, that you see the debt to GDP of 124%. That means we're borrowing more than we're bringing in, and it's very, very significant. So the question that we ask, Kerry, right, is, how long is that sustainable?
Exactly. And, what I was just thinking of, Ryan, while you're saying that is, this is what our kids are growing up with. Like, This is like the normal, that you have generations growing up in this environment. They don't even know what it's like to not have this kind of debt. So, yeah, this is so folks, that's some foundational things for you. Going off the gold standard and the trickle down effect that had with the loss of the purchasing power, that's what's going on underneath everything. So let's dive in a little bit deeper now, Ryan, with 3 inverse relationships. Because I'll tell you, as an advisor, this is the conversation in addition to what we just talked about. But I want some real levers to turn for my clients. And when these inverse relationships help my clients understand, like, okay, so if I have this go down, what do I own that goes up? You guys are used to preaching the message, and so am I, about, okay, we can have laddered growth, we can index in an FIA and not go backwards and those kind of things. But of course, we're trying to, hope that goes up at a good way, and we fight renewal rates and that whole thing. So that's a great stabilizing force, and especially to separate growth producing assets from income producing assets, right? Which is I'm talking to advisors today, so let me talk shop a little bit. So that's how you start mitigating sequence of return risk and doing income planning, right? Well, think about their money that's in the market. What is some kind of counterbalance that you could actually help with the money that's in the market? And I'll tell you, when COVID hit, my clients, because I'd educated them correctly in the beginning, thanks to Ryan teaching me years ago, and me then seeing it and doing my own study for my own self, because they were educated, my clients knew, you'll see here in just a minute, why their metals went up when their accounts were going down some, and it kept them very, very calm. So Ryan, walk us through this counterbalance of these 3 things: the US dollar, real estate, and stock market over certain cycles.
Yeah, so these are your 3 asset classes that we all have. When you're talking to a client, what I like to say is if I'm talking to a client that does not have any exposure to any physical metal, I tell them, guess what? You're all on one side of the fence. You're all in the same basket. And they go, no, I'm well diversified. Well, the problem with diversification is it's all classified under US dollar terms, right? So it doesn't matter what they're diversified into. We look at this, we call it a seesaw or a teeter-totter type experience that clients have. But when you have an asset class like gold and silver that play this opposite inverse role, we call it a non-correlated asset, that's how they fit. So you take a look at these, the dollar and real estate and the stock market, and we'll do a very quick deep dive on those. But the whole idea here is a counterbalance. In this market we're in right now, with the fear of missing out and everything that's happening right now, with the prices of precious metals rising, the question we get often is, well, I'm going to wait for a pullback, or maybe I hear that often, or the question is where do we think the price is going to go? Did it peak? And I tell people, I don't care where the price of gold and silver goes, because it has this inverse seesaw action here that balances out clients' overall wealth level, Kerry, right?
Yeah, absolutely. And we've seen that happen. Look at the market cycles we've been through and seen literally that counterbalance. We're going to show some real stark examples. So let's dig into the dollar first. We'll talk about purchasing power. And for years, you guys, we would do this little analogy of a silver dollar in 1950. You could buy 10 gallons of gas with $1 silver in 1950. And in every year Ryan's been doing this, he could say in one way or another that $1 silver would still buy 10 gallons of gas. So in 1950, a gallon of gas was 26 cents, 10 gallons, $2.60. Do you think $2.60 would buy 10 gallons of gas today? It wouldn't even buy 1 gallon. Well, maybe 1 gallon. Okay. But what's happened is this silver dollar in 2026 has held its purchasing power so strong. Not only will it buy 10 gallons of gas, but we had to add a steak dinner to this slide just to show you a fair comparison, right, Ryan?
Kerry, we've had this slide up hundreds of times for agents and advisors. And this is the first time that it says plus a steak dinner. It always, we're talking, what does silver and gold do? And what buys you today buys you tomorrow mentality. Well, okay. You want to talk about silver right now. I'm going off a tangent just a real quick, Kerry. Silver right now, folks, is gold on steroids. Okay. We talk about wealth insurance over and over again in all of our branding materials. You've heard me say this before just a few minutes ago. You'll hear me say it again. That's what gold and silver does, it's insurance, right? When the price of insurance is rising and people are paying for it, that usually means calamity is right around the corner. If insurance is high, it means you're at risk, and vice versa. And that's where we are right now. It's very. This is a fun slide to me, Kerry, because it's changed. And you want to talk about keeping up with your purchasing power and then some. That's what precious metals do.
Yeah, Ryan and I, we don't like to overstate stuff. We're very conservative. We love, we want to stay very compliant. And so we're always kind of downplaying the big surges and that kind of thing and sticking with the long-term thing. But, at some point, that beach ball that's been held under the water so long, which is that national debt you saw and the loss of purchasing power, at some point, the pressure on that is just continuing to break through. And that's why you have people calling for like $300+ silver, some more, things like that. So the purpose of this slide, though, you guys, is just to, out of those three inverse relationships, we're just showing you that the purchasing power of that original silver dollar and the money that it took in 1950 had an inverse relationship. The amount of money it takes to buy $10 of gas went way up, and the silver stayed the same. It's like its value went up. You didn't have to have more coins. So that's purchasing power. Let's go to the next one, real estate. We talked about that. Here's just a quick snapshot. Ryan has a wonderful whole expose on like $100 years of like real estate prices in gold and going up and down and inversely operating back and forth. But this is just a snapshot how in 07, 08, the red line is gold. I didn't make the color of the lines, by the way, but it's red. And then you can see the Dow Jones real estate there in green. So boom, market goes down and gold went up. So when we're seeing that, we're going to show that to you in a more vivid way here in just a moment. And then here's more on the market. Dow Jones versus gold to present. Now this says 2025 to present. It should say the last 10 years. That's a mistake. But this is 10 years here of the gold in orange versus the Dow in blue. Okay. So Ryan, look at that. We got a big tail going up there on the right-hand side, but what's before that is very telling as well.
Well, the reason why we want to show this, Kerry, from more of a longer perspective instead of just a short little window is, yes, historically, gold and silver play an inverse role to our stock and equity markets. We see a 2008 type crash, right? Gold and silver it rose up significantly because everybody's 401ks turned into 201ks, right? They trade places. So that's the whole concept here. But we want to show that there are instances, and we're experiencing that now, that instead of trading places, they also go up in tandem. And a lot of that tandem reality is because of I'll quick soapbox this. A lot of that tandem reality is because of the free money that keeps being injected into the system, because we're adding $1 trillion every 90 days. It has to go somewhere, folks. And that's part of the rationale of what we're seeing right now.
Yeah. So Ryan, is there an easy way to explain to the folks today, like, why does silver, if somebody said, okay, well, why does gold and silver have this innate pull to purchasing power? Like, why does it maintain its purchasing power over those years? What force is causing that?
I mean, it's simple demand of 6,000 years. Gold and silver is money, right? I'll raise my hand. I took many economic classes, but in economics 101, the definition of what is money. Money is a store of value. That's what gold and silver is. So the technical definition is gold is money. What we see here from especially 1971 to now, our dollar's not money. Our dollar's currency, which is a medium of exchange. Okay,
right.
It's storing value because gold and silver is real money, and it goes back 6,000 years. It's that simple. Yeah,
so it really comes down to the fact of, like, we innately as a people place a lot of value on that. Like it just seems to have that attribute of scarcity. There's not going to be any more made special. And so anyways, it's where people run in hard times. But it just has that organic reaction to it. It's fascinating, isn't it? how that happens, but it's proven out for many years. And so Ryan wanted to pull this slide, you guys, because it is busy and everything, but I told him to leave it because I wanted you to be able to see a little more proof of market cycles of the inverse relationship that it has between the stock market and physical gold and silver. So you can see in the middle there, those are big S&P 500 decline periods, right? So in the red, that's how much the S&P went down during the years over to the left. And then in the green, you'll see the response of pre-1933 gold and silver. And this is basically a 70% silver, 30% gold blend. And so again, we're not trying to like sell the sizzle or overstate anything. This is actually just what happened. So we just want you to know it really, really does this, right? And then let's move on to one little snapshot. Here's 2020. This was fascinating to watch. And that is, you see the S&P down 31%, but silver spot price went down. I want you to address that, Ryan, and then you can see the physical went up. So help them understand what drug that silver spot price down.
Well, and that goes back to the first few slides when I gave that awful example of the Titanic.
Yes,
right? We have
does.
On the right side is your life preserver that's real, you possess it. And on your left side is the Monopoly chance card, right? Saying you own a certificate. The difference here, Kerry, when we have large market losses, okay, when these large hedge funds, when these large dealers and banks are liquid, I mean, everything's a sell. They're having to sell everything to come up with margin calls and all these things. So the stock market gets brought down. So does the paper gold and silver price historically. Okay, but again, when these big funds, when they're selling paper, they're not selling any physical. When they're doing that, that's when, especially when we have these market volatile type events, 2008, 2020, when the S&P and the stock markets drop so much, that's when everybody panic buys and they buy something tangible, right? So you can see the difference of, this is just a snapshot of, hey, the spot price actually went down 36%, but the physical metal, instead of going down 36%, actually went up over 22%. That's the biggest difference here. And the myth that people have of, well, I can get in to physical at the paper price, or the paper's just the same. It's not. Two vastly different things.
Yeah. So think about it this way, you guys. We could, if let's say we charted 20, 30 years of the stock market, spot price, and physical. If we extracted out of that chart the big sell-offs in paper, gold, and silver, that drug the spot price down, which we don't care because we own silver. I mean, we would care if we were owning paper shares. But if we extracted those big sell-offs of paper, you would see the spot price tracking and keeping its purchasing power too. But we have these interruptions by the big sell-offs in paper that it temporarily upsets the apple cart with the spot price, But if you own physical, you're on the right side of that trade, as they say.
Right.
And you just be patient, right? Because it comes back. All right. So we hope that clarifies these things for you. As far as you can see, this is broke down a little bit further, dollar-based assets. We originally said the US dollar, real estate, and the stock market. And you can see here, we're just breaking that down. This is what your folks own. And so they need that counterbalance.
Yeah. I mean, that's it. I mean, folks, I use this seesaw teeter-totter example all of the time in my conference room with my personal clients. You can see this on your screen. Real easy to, if you're actually watching this, real easy to do with your arms like this. You've got the counterbalance on one side and the counterbalance on the other, right? So I tell my clients this. I say, great, now that you have your gold and silver on this other side of that seesaw, I hope your gold and silver lose extreme value. I hope you lose your shorts in gold and silver. And they usually sit there and ponder for a half second, and almost, I mean, you can see the arms cross and the scorny looking eyes, and they go, why would you wish that, Ryan? And I say, remember, all we're talking about here is a small percentage of your overall wealth in gold and silver that has enough weight to offset all of your other diversified dollar-based assets. Okay. If your gold and silver does well, that means all of your dollar-based assets are not doing well. And they represent the majority of your investable assets. So it's the whole be careful what you wish for scenario, but that aha type moment for them, if you get anything out of this conversation we have here, and you're talking to a client that has done this, you have to say stuff like that. Kerry, you didn't get calls during the 2020, flash crash. You're not getting calls during the 2008 crash going, where am I at? Because they know their gold and silver is the protection mechanism to act as that inverse relationship.
Yeah, they really did. They really did. And, what you made me think of is when you're telling that story, Ryan, is if you overcomplicate this, everybody, then you're not going to have a great experience with it. Okay. It's a fun topic to talk about. These are bedrock foundational economic issues that we're just trying to simply address. And really, we're just giving you the chance to be an access point for your client base to physical metals in a way that has integrity, in a way that has years and years, decades of experience on how to go about it. Not you becoming a gold expert, knowing, like, what is this coin? What is that coin? I mean, right. The retail universe out there of gold and silver creates all kinds of weird stuff just for marketing purposes. This coin and that coin and the Gulf of America coin or this, Yeah. And so anyways, it's just, you got to keep it simple. If you learn these foundational things, it doesn't mean that you're not doing it full due diligence for them, but it really is not complex when you get down and creating that simplicity. And so here's just a couple of case studies for you with a couple of, these are kind of old, where this is back, Ryan, when we used to talk about a 10 to 15% allocation. Talk for a second while we're here about really what that's kind of changed, and we're leaning more really to a 20% allocation, and there's some big financial institutions that are doing the same thing.
Yeah, Kerry, for years, all we were talking about is roughly a 10, possibly a 15% allocation of one's wealth. So a cliche $1 million client, you're talking 100,000, 150,000 at most into precious metals. Again, that's the weight of the counterbalance of that seesaw teeter-totter. Okay. Now in the marketplace that we're in with the dollar, I call it the dollar's demise. I'm not calling for the dollar to go away tomorrow. That's not my intention. But I am telling you, when it's government numbers and they're saying that there's $1 trillion of debt every 90 days, that's being added to the system. Morgan Stanley, Goldman Sachs, the big hedge funds, the big traders, they were always in that 60-40 stocks to bonds portfolio. Just last year, latter part of last year, they came out and they said it's no longer 60-40 of what they're allocating their clients into. They're into 60-20-20, and that 20% addition is gold and silver. Okay, so essentially what they did is they took a 50% haircut of what they were normally allocated into bonds, government debt, and they're adding gold and silver into the mix. And so Kerry, it makes me ponder if the big wigs, the big talking heads that used to be only at a 5% allocation before all this came out, and now they're at 20, we better be doing it too. That's for sure.
Yeah, something's up with that, right? So you real quick, you see this is a good sized client. Here they are, you see in the middle there, a 10% allocation. But I just wanted to tell you, like, when I educated this client in the very beginning, it didn't start at a full 10%. We started, I think, with 50 and then added another 100 and added another 100. But I also wasn't a wimp and just said, oh, just stick your toe in the water. No, I taught them economically the same stuff I've taught you, but I did it in probably 10 or 15 minutes. And they understand that. Like, people want to have that safeguard of what they've worked so hard to build. And so it just became a timing thing of, okay, when this is released, boom, boom, we fund it. So that's a non-qualified situation. Here's a qualified situation, right? Some of your people are only going to have IRA dollars, and Ryan and I'll tell you, if you can do your allocations of physical metals out of non-qualified money, that's going to be a whole enriched experience for them. They get to hold it themselves. They get to have a different type of coin that has some organic properties and even legal properties to it that they would enjoy. This way here through an IRA, it's still, like, I've got clients and even family that are like, really happy about where their IRA is at, the part that we put in metals. And you see this client here, you see a higher percentage here because he didn't trust the government. You could say he saw some of this coming, Ryan, or he really understood the forces at work, and he wanted a higher allocation, and so we were able to facilitate that without it being a taxable event. So a couple case studies for you. It's just a fun piece to fit into the planning, and it's something that people are looking for. So let's come back to you. How do you incorporate this into your practice? Well, you took step one today, right? And now the only thing left is to get your quick start kit. And then we call it just start talking to people or send out a simple email. So Ryan, when somebody grabs this quick start kit that we're going to offer them here at the end, that starts a chain reaction. Walk them through that.
It does. Remember I said in the beginning that we were a glorified IMO, but in the precious metal space. This is where the rubber meets the road. You head to goldensilveradvisors.com. We have that S capitalized at the end just to show you that it's plural and not singular. And there's a little button that's going to say purchase your quick start kit. And we've got a code for you that we're not asking you to pay for anything. We're going to give you a free code that you apply at checkout here. What this is for is it starts the chain reaction of knowledge, information. We have a few hours worth of on-demand videos, which covers, the meat and potatoes, right, Kerry, like we say, in much greater detail than we just gave you right now. If you want to become educated, you want to become an authority. And I love that you said that, Kerry, you go, I wasn't a wimp. If you don't want to be a wimp in front of your clients, so to say, this is what it's for. But after you sign up for your kit, my office, my team will reach out to you, and we're going to be collecting things such as, hey, I need your print logo. I need this so we can brand these materials for you. We don't charge for that. We want to make you look as successful as possible. And this gives you, unlimited access to all of our downloads. We have client materials, and in addition to this training, you see right in front of you in bold, the Advisor podcast. Head to your favorite place that you listen to all your podcasts. You type in Advisor Gold, the missing allocation, and you're going to see, 25, 26 episodes of Kerry and I going into greater detail of a lot of the common topics and questions your clients are going to have.
Yeah. And we'll come back to that. We'll get that code here in just a second, you guys. We thought it would be good to just give you a quick overview. The training is exactly what you need to understand why I said you don't have to become an expert, but you need to know you need wisdom, right? So the world is drowning in information, okay, but starving for wisdom. And like when I mentioned not being a wimp, Ryan, the opposite of that is being a leader. Your clients need leadership, right? And they need wisdom. Right. And so that's what you're trying to bring to them. And so these sections, how to bring up to your clients, these sections of the training are going to cover that. And so spoiler alert, Ryan and I have a date on the calendar to actually redo and update the whole thing. So if you see a little bit of age stuff in there, timing wise or dates mentioned, it's the new version's coming. So section 1 is that. Section 2 is why. Back to the why, right? Why we use what we use. So we're going to answer those 5 key questions for you there. Why for you to be able to know how to do it for your clients. Why should I own gold and silver, right? What kind should I own? How much should I own? What do I do with it when I have it? And then how do I get rid of it? You got to answer those questions. Client, you don't want them to ever sell it, but they need to know on the front end. They're going to ask you if you don't bring it up. So you learn the answers to those 5 key questions, and then you have got your whole little talking points, right? And it's kind of like, it's kind of like love, like you can have a conversation with anybody and you can always bring it back to love if that's your goal with them. And so that's a crazy metaphor. I've never used it before in this webinar, but no matter what they talk about in the economy, you can always bring it back to this 6,000 year foundational thing that Ryan just mentioned a few minutes ago. And then, of course, we're going to take care of you on logistics. What about the paperwork? Hey, listen, it's 1 page for non-qualified. It's more or less an order form, but there's some cool stuff on that order form that protects you. The qualified IRA process is what it is. Ryan has his own team inside the custodian that's dedicated to him. Relationships, long-standing for those things. We shop those prices, make sure your clients are getting the best pricing for storage and things that the government requires, and so we're also going to talk about mindset. I hope you get the drift through this thing that this is not a stock, right? And so the way you teach clients about this is important, that you get their brain out of, oh, what's my price today? Where can I check the price of my coins? Where can I check? Well, it's more like real estate. Okay. So you don't like jump in and check your real estate prices every day. Now, when we see a cycle change or we're curious or we're thinking, we go and check then. That's how this is too. So more about that, FAQs, logistics, and all that. And then, of course, marketing. And Ryan alluded to this a few minutes ago, the different items and if you're the kind of person who loves that kind of thing and you're going to use it, it also comes down as simple as, number one, integrating into your annual reviews, but you want to do some kind of outreach. And Ryan, share with them a quick story from one of your recent webinars or an experience you had recently with an advisor in this category in the last 6 months.
Yeah, well, the big thing is we mentioned, Kerry, the step 3 of this is open up your mouth or send out a sample email, right? We had a brand new advisor of ours that just came to us, and he started letting the masses know that he facilitates gold and silver, right? Because if it's not you bringing it up to your clients, somebody else is, and they're seeing it all over the news, and they're going to go the retail route and historically pay a much higher rate. And there's a lot of buying pitfalls with that too. But he sent the email off, but he obviously called what he calls his A-list clients. There's 8 of them. And one of them was selling a business, and they were retiring off that. Lo and behold, this client was saying, yes, I was already planning on doing this anyways. I didn't know you did this. I haven't done it yet. And lo and behold, just a few months ago, sold his business. We did about 10% in metal at that time, $1.7 million. The advisor made 4% commission on that. Right. Then he received his first quarter's worth of dividend on that, buyout, which was $500,000, and the client placed another $500,000 into metal, and it just keeps on coming. And all it takes from something like that is just simple client awareness. We've had different webinars titled, don't be a secret agent. And, if things like that, folks, you just got to let your clients, your prospects know that you're a resource for it. Right, Kerry?
Absolutely. So you saw the list earlier. We spent enough time on this before. Hey, the resources are there. Hey, you don't have to do what I did a long time ago when I first met Ryan, and that was get on the phone with him for 15, 20 minutes and write notes feverishly, and then go try to apply what he taught me, and then go back, get on the phone with him again and say, you don't have to do that. And so all you have to do is just hop right on goldandsilveradvisors.com, put that coupon code in, and you'll get access to those modules. And so it's timeless information. Again, it's just a differentiator for you, right?
Kerry, you mentioned timeless though, and yes, in a few months you're going to see updated material in this. Use the coupon code that's all capital NGC 2026. That'll get you 100% discount. We just don't want folks in there that shouldn't be in there. That's why there's a price tag to it. But there's a reason why we're updating it, Kerry, and we're not going to be changing a whole lot of the meat and potatoes because it is timeless. You just get to see a younger version of Kerry and I on your screen, which might be good, right?
That's right. But you're still bald all these years.
It turns out it doesn't go the opposite route. It's not like I'm getting any more hair, Kerry.
That's true. So thank you for attending. I don't know if Reagan's coming back. Do you, Ryan?
Yeah, she's right here. She can end it for us. Go ahead, Reagan.
Yeah, absolutely. Sorry, just the last comment about Ryan's hair made me chuckle quite a bit. You can tell you guys have been working together for some time now. I like it. Okay, so we did get a couple questions submitted to me, and then I just have a couple that I thought up as well. But I think the one that I want to start with, and I guess this is for Kerry, how do you explain the role of gold alongside annuities or other insurance when clients are already feeling protected by income solutions? You know, it's like, how are you starting that conversation when they already feel like they have everything they need?
Yeah, so it goes back to purchasing power of the dollar, you guys, and so it's just kind of bringing it up in when you're in those formative conversations, or once you kind of like have that income solution in place, like you said, gold and silver is not about income. It's about protecting the overall wealth, right? So let's say that you put 40% of their assets into some type of protected growth with an insurance company you're trying to create there, right? And then I don't know if you're the advisor or not on the assets under management on the market side, but it really just becomes the same things we talked about today. That counterbalance. So hey, this is great. We got your growth producing assets now separated from your income producing assets, but there's one area that's not covered here, and that is overall foundationally. What do you guys think is happening, with uncertainty in the marketplace? You just start asking questions, right? Use a Socratic method of seeing, and ask them a couple of just overall questions. How are you guys feeling about the general economy? Where do you think we're going as a country with this 39 trillion of debt? What kind of impact do you think that's going to have? We've got your guarantees here with longstanding insurance companies. But I don't want to just leave you hanging on the rest when it seems to me you might have a missing puzzle piece here. So you haven't even mentioned the word gold and silver yet, right? And so you got to hear what's in their head. What are they concerned about? Okay, because people take action to solve problems, right? And so once they voice those things, that's why I say all roads lead back. Because guess what? They're not going to say, oh, I think the national debt is great. I think we're going to be just perfect as a country. They're going to have some thoughts about it. And they say, well, I've been on a kind of a journey of discovery myself. And I decided to work with one of the nation's leading gold and silver, physical gold and silver providers that only works with financial advisors. And so I'd love to explore that with you. Were you aware that gold and silver has an inverse relationship to kind of the stock market and real estate, things like that? Were you aware of that? No, I wasn't, And so you just plant those seeds, schedule a conversation, and then their attention is focused on it. Review the training, call Ryan's team, talk to his people before that meeting, when you're first learning, and keep it simple.
Yeah, I like that. Yeah. Ryan, when advisors are starting to think about gold and silver, what's kind of the first or most common question that you're hearing from them?
Most common question would be, what are your minimums? and I go, man, if I could just have a fly swatter to hit the guy in the face when he asks me that question, because they're just missing the entire boat when it comes to what they're trying to do here. We're not coin peddling. We're not this little trinket selling type of machine that says, I've got this extra $5,000 in my checking account that I haven't used for years, and that's what I'm going to do. And lo and behold, that client's net worth is $5 million, right? The example, when a client or an advisor asks me that question, here's what I tell them. And I say, minimums should not come up, because everybody's 20% of their overall, nest egg and net worth are vastly different. The example I give to them is this. I live here in St. Augustine, Florida. My home is literally surrounded by the Atlantic Ocean on all four sides. Any window I look out, I see the Atlantic Ocean. Okay. So to say that I am at hurricane risk is an understatement. My elevation on my home is literally 10 feet. Okay. So my cliche $1 million home, I wouldn't have only $10,000 of hurricane coverage for it. Right? Why? At that point, what is that going to do when a hurricane rips through and my house gets blown down like the Three Little Pigs? It's not going to help me. So that's the conversation I have with them, and to say, that's where Kerry mentioned, that's where my brain went to. I don't want to be a wimp. Well, that's where you have to be authority, and you have to tell your client what 20% is. Let them do what they want with it. But if they're less than 20%, Reagan, I'll end with this. I tell people, anybody with less than 20%, you're placing a wager, you're placing a bet on our government and our dollar. Okay. I don't want to be on that side of the wager. I'm sorry.
Yeah. I got to jump in. So in those client conversations, when that minimum question comes up, like you said, Ryan, that's instant feedback that you just screwed up, right? You did not do a good job of helping the client understand why we look at it as an allocation and the counterbalance that it's there to provide, right? The reason why it's instant feedback is it just tells you right away, like, okay, I either didn't say this right, or they're just so bent on not, I didn't set it up right. We didn't crack it open and hear what they're interested in first. We didn't hear their why, right? Because when you hear that, it's not too late, but just know that if you continue down that path of the minimum with that client, you're not doing them a good service. You're doing them a disservice, and you're really just going to create a problem, because you're going to do some work. Everybody's going to do a bunch of work, and the client's not going to have what they need to do them any good. So right. If they do $10,000, for example, then take everything we said about what it can do for them and just throw it in the garbage. Okay. They can just, it's just a hobby, or it's just a little activity they want to do on the side, but it's not going to provide any counterbalance. So I'll just end it with this, because I could get on a soapbox here. The thing is that you have to get your own convictions about it. So watch the training, talk to Ryan's team, talk to Ryan. You have to have your own convictions, because those convictions, and see for yourself the counterbalance in the inverse relationship right there in front of you, because those convictions is what's going to come through when you have that client conversation. So I'll cap it with this, here's where the rub, here's what you're looking for. What you're looking for is not what's the minimums. What you're looking for is, okay, so I see what you're saying. I need, 15, 20% to provide that counterbalance. I don't really see how I can do that right now, Mr. Advisor. So what if we started with fill in the blank, 50, 100, whatever their number is, you've calculated the 20 for them, and say if they're $1 million, that's 200 grand, right? So then it becomes just a mission of, okay, how can we eventually get 200 grand into physical gold and silver, even if we need to start with 50 or 100. But you see how the client's mind is properly educated. They're on the right track. That's what's going to help them reach their goals, not the minimum.
Yeah, I really like how you guys do a really nice job of, I don't even want to say simplifying, but bringing clarity to what advisors need to talk about with their clients. I really appreciate that. We are just coming up on the hour here, so I am going to cut off the questions there. But if you guys have any more, obviously, feel free to reach out to NFI Solutions or National Gold Consultants, and we'd love to help you. But specifically to you, Ryan and Kerry, I just want to thank you guys for your time today. I really appreciate it. You guys are excellent speakers, and I'm really glad that we were able to put this together and just talk a little bit more about, how gold and physical metals can kind of supplement security for agents' clients. And then thank you to everyone who joined us and participated in our discussion today. We really hope that today's session was both helpful and provided some useful information for you as you kind of navigate these conversations with clients. And like I said at the beginning, our recording will be sent out to all the registrants. So if you guys have any questions, you want to go back through and rewatch something or relearn something or get that code again so that you guys can work with National Gold Consultants, please feel free to access it. And if you guys have any additional questions, please feel free to reach out. But with that, we're going to go ahead and wrap up today's session. Thank you again for joining us, and I hope everyone has a great rest of their day.
All right. Thanks, Reagan.
Thanks, everyone.
Thank
Bye,
you.
everybody.